In today's world, getting a ride is no longer about hailing a taxi. It's about opening an app, pressing a button, and having a car arrive within minutes. And behind that simple experience, two companies dominate the market: Uber and Lyft. This is not just a competition between apps. It is a battle for control over how people move through modern cities. The story begins in 2009. Uber was founded with a simple idea: tap a button, get a ride. At the time, taxis were slow, inconsistent, and often inconvenient. Uber solved that problem using technology: GPS tracking, cashless payments, real-time ride matching. It wasn't just better, it was a completely new experience that changed user expectations. Just a few years later, Lyft entered the market. Founded in 2012, Lyft positioned itself differently. While Uber focused on efficiency and scale, Lyft focused on friendliness and community. Early Lyft rides even included things like fist bumps between drivers and passengers. It may sound small, but it showed a clear difference in brand identity and customer experience. From the beginning, Uber had one goal: dominate globally. It expanded aggressively into cities around the world: North America, Europe, Asia, Latin America. Uber moved fast, entering new markets before competitors could react. Lyft took a different approach. It focused almost entirely on North America. Instead of global expansion, it concentrated on building a strong presence in the United States and Canada. By the late 2010s, the difference in scale was clear. Uber was operating in over 70 countries. Lyft was primarily limited to the US and parts of Canada. From a business perspective, Uber had a massive advantage: scale. More markets, more users, more rides, more data to improve its system, but growth came at a cost. Both companies spent billions of dollars to expand. Driver incentives, discounted rides, marketing campaigns. For years, neither company was consistently profitable. This created a major question for investors: could ride-sharing actually become a sustainable business? Let's break down how these companies operate. Both Uber and Lyft use a similar business model. They connect drivers with riders, take a percentage of each ride, and scale through network effects. The more drivers on the platform, the faster riders get picked up. The more riders, the more drivers earn. This creates a powerful feedback loop, but it also creates intense competition because drivers can switch between apps easily, and riders often choose based on price. This leads to one of the biggest challenges in the industry: low switching costs. If Uber is cheaper, users choose Uber. If Lyft is cheaper, users choose Lyft. There is very little loyalty, which means both companies must constantly compete on pricing, wait times, and driver availability. Over time, this has made pricing strategies extremely aggressive, especially during peak demand when both platforms try to balance supply and demand in real time. Now let's compare the numbers. Uber is significantly larger. It generates tens of billions in annual revenue and completes billions of rides per year. Lyft is smaller, with lower revenue and fewer rides, but it has carved out a strong position in the US market. In some major cities, Lyft holds a meaningful share of rides and remains a serious competitor. Another key difference is diversification. Uber has expanded beyond ride-sharing. Uber Eats, freight, logistics. This allows Uber to generate revenue from multiple sources and reduce its reliance on a single business line. Lyft, on the other hand, is more focused. Its business is centered primarily around ride-sharing. This makes Lyft simpler, but also more exposed to changes in demand. Profitability is another major factor. For years, both companies operated at a loss, but recently, Uber has moved closer to consistent profitability. Its scale and diversification have helped stabilize its business. Lyft has struggled more in this area. Its smaller size makes it harder to absorb costs and compete at the same level. There is also the issue of regulation. Ride-sharing companies operate in a complex legal environment. Driver classification, insurance requirements, local regulations. These factors can significantly impact costs and operations. Uber, with its global presence, faces more regulatory challenges. Lyft, being more focused geographically, deals with fewer regions. but still faces intense scrutiny in the United States. From a brand perspective, the two companies are also different. Uber is seen as the dominant global platform, efficient, reliable, widely available. Lyft is often seen as the more user-friendly alternative, more approachable, more community-focused. So let's compare them directly. Scale: Uber dominates globally. Lyft is limited to North America. Revenue: Uber leads by a wide margin. Lyft trails behind. Diversification: Uber has multiple business lines. Lyft is mostly ride-sharing. Profitability: Uber is closer to consistent profit. Lyft is still catching up. Brand: Lyft has a more friendly image. Uber has stronger global recognition. So who is winning? In the short term, both companies are still competing heavily, but in the long term, Uber has the advantage. Its scale, diversification, and global reach give it a stronger position. Lyft remains a solid competitor, but it is operating within a narrower space. And in a market driven by scale, that matters. Because in the end, this is not just about rides, it is about infrastructure, about building the systems that move people through cities efficiently. And the company that controls that system controls the future of transportation. And as cities continue to grow and transportation evolves, the competition between these platforms will only become more intense.